Chapter 18 of The Intelligent Investor by Benjamin Graham, titled A Comparison of 8 Pairs of Companies, dives deep into the world of comparative analysis to illustrate how two companies in the same industry can possess vastly different financial health, stability, and investment potential. Graham's central goal in this chapter is to show that investors must evaluate companies based on their individual financial metrics, and not assume that all firms in the same sector are of equal value. Through the methodical comparison of key financial data such as earnings, dividends, and debt, Graham demonstrates how to identify stronger companies and avoid weaker ones. This chapter serves as a practical guide for applying the principles of security analysis that Graham has discussed throughout the book. By analyzing the specific financials of companies, investors can make informed decisions rather than relying on general market trends or the assumption that all companies in a given industry are equally sound investments. Let's take a closer look at the key lessons from each of the 8 pairs of companies Graham compares and the broader takeaways from this important chapter. The purpose of comparative analysis, as explained by Graham, is to demonstrate that even though two companies may operate within the same industry, they can have vastly different investment prospects. For Graham, financial strength is not just about being in the right industry, but also about how well a company is managed, its financial policies, and its long-term growth potential. He encourages investors to delve into the details of a company's financials to understand its intrinsic value. Graham focuses on several key metrics in his comparisons. 1. Earnings stability. Consistency in earnings is a hallmark of a good investment. Companies that show stable earnings over time are more likely to weather economic downturns and provide steady returns. 2. Dividend policy. Dividends are a sign of financial strength. Companies that regularly pay dividends tend to be in better financial health and are committed to returning value to shareholders. 3. Debt levels. High levels of debt can signal financial instability. Companies that are highly leveraged may struggle during tough economic conditions as they are burdened with interest payments. 4. Price to earnings, PE ratio, a key measure of a company's stock price relative to its earnings. This ratio helps investors determine whether a stock is overvalued or undervalued compared to its actual earning potential. 5. Growth potential. While growth is important, Graham emphasizes that investors should not chase growth for its own sake. Growth must be supported by strong fundamentals, not just market hype. The first pair Graham compares consists of National Biscuit Company, which later became Nabisco, and Continental Baking, famous for its Wonder Bread brand. Both are in the baking and packaged foods industry, but their financial profiles differ significantly. National Biscuit had a long history of stable earnings and consistent dividend payments. It was a well-established company with solid financials, and its stock was priced reasonably based on its earnings. Continental Baking, on the other hand, showed less earnings stability and had more fluctuations in its financial performance. Although it was also a recognizable brand, the company's management and financial policies made it a riskier investment. The takeaway from this comparison is that a company's brand recognition or place in the market should not be the sole determinant of its investment value. Stable earnings and a conservative financial policy are far more important for long-term investors than a company's visibility or market position. Pair 2, Chrysler versus Studebaker. In this comparison, Graham examines two automotive companies, Chrysler and Studebaker. Chrysler, one of the big 3 US automakers, was a larger and more stable company with a strong market share and reliable earnings. It had a strong balance sheet and had managed to grow steadily, making it a relatively safe investment in the volatile auto industry. Studebaker, on the other hand, was a smaller automaker with unstable earnings and a history of financial struggles. Its stock was often seen as speculative, as the company faced numerous challenges, including competition from larger automakers like Chrysler. This comparison highlights the importance of looking at a company's financial resilience and competitive position within its industry. Even though both companies operated in the same market, their fundamental financial differences made one a safer bet for the intelligent investor, while the other was far more speculative. Pair 3, Coca-Cola versus General Cigar. In this pair, Graham compares Coca-Cola, a world-renowned beverage company, with General Cigar, a less well-known company in the tobacco industry. Coca-Cola was an obvious choice for conservative investors, with consistent earnings growth, a solid market position, and a long history of dividend payments. Its brand dominance made it a strong and stable investment. General Cigar, while profitable, lacked the same level of stability and market presence. Its earnings were more volatile, and its future growth prospects were less certain. Graham uses this comparison to underscore that even though both companies were in the consumer goods sector, Coca-Cola's strong brand, stable earnings and conservative financial management made it a far more attractive investment for the defensive investor. Pair 4, American Can versus Continental Can. This comparison between American Can and Continental Can, two companies in the packaging and canning industry, focuses on the importance of earnings stability and financial health. American Can was a larger company with a strong track record of earnings stability and reliable dividend payments. Its size and market position made it a safe investment for the conservative investor. Continental Can, although in the same industry, had more erratic earnings and a higher debt load. This made it a riskier investment, despite operating in the same market as American Can. The lesson here is that even within the same industry, differences in management practices and financial policies can make one company a far safer investment than another. Pair 5, Anaconda Copper versus Phelps Dodge. In this pair, Graham compares two companies in the copper mining industry, Anaconda Copper and Phelps Dodge. Anaconda Copper was a large, well-established company with diverse mining operations. However, it was also highly leveraged and vulnerable to fluctuations in copper prices, which made its stock more volatile. Phelps Dodge, while smaller, had a more conservative financial policy and lower debt levels. This made it a safer choice for long-term investors, even though it wasn't as large as Anaconda. This comparison highlights the risks of investing in companies that are heavily reliant on commodity prices and the importance of debt management in industries prone to cyclical downturns. Next, Graham looks at two consumer products companies, Colgate-Palmolive and Lever Brothers. Colgate-Palmolive had a strong reputation for stable earnings and consistent dividend payments. It was a well-managed company with a solid financial foundation, making it a good choice for defensive investors. Lever Brothers, while also a significant player in the consumer product space, had more volatile earnings and faced greater uncertainty in its future growth prospects. Graham uses this comparison to emphasize the importance of earnings stability and management quality in choosing companies within the same industry. In the seventh pair, Graham compares General Electric, or GE, with Westinghouse, two giants in the electrical equipment industry. General Electric was the clear winner with a history of steady growth, consistent dividends, and financial stability. It was a well-managed company with a diversified product line, making it a safe investment for conservative investors. Westinghouse, while also a large player in the industry, had more erratic earnings and faced greater challenges in maintaining profitability. This made it a riskier investment compared to GE. The key lesson here is the importance of management quality and a company's ability to maintain financial stability even in competitive industries. The final pair Graham examines consists of two retail giants, Sears, Roebuck and Company, and Montgomery Ward. Sears was a dominant force in the retail sector, with consistent earnings growth and a strong brand. It had a solid financial foundation and was a reliable dividend payer, making it a good investment for conservative investors. Montgomery Ward, on the other hand, faced more challenges and had less consistent earnings. It struggled to compete with Sears and other retailers, making it a riskier investment. Graham uses this final comparison to underscore the importance of a company's competitive position within its industry. Even if two companies are in the same market, the stronger, better-managed company is usually the safer investment. Chapter 18 of The Intelligent Investor serves as a practical guide to applying the principles of value investing through comparative analysis. Graham's examination of 8 pairs of companies highlights the critical importance of looking beyond surface-level industry classifications and digging into each company's financial health, earnings stability, dividend policy, and debt levels. The chapter reinforces Graham's belief that intrinsic value and a company's long-term financial strength are far more important than short-term market trends or speculative hype. By carefully analyzing the financials of companies within the same industry, investors can make informed decisions that align with the principles of value investing and ultimately achieve better long-term results.
Thank you for watching. Share this with friends and family, and please subscribe.